Imagine buying a company, not because everyone else is buying it, not because it's trending, but because you believe that 10 years from now, it will still be one of the best businesses in the world. That simple idea made Warren Buffett one of the richest investors in history. But surprisingly, his greatest investments didn't start with complicated formulas. They started with one simple question. Would I be happy owning this business if the stock market closed for the next 10 years? After graduating from Columbia University, Warren Buffett began working for his mentor, Benjamin Graham. Graham taught Buffett something Wall Street still struggles to understand. A stock is not just a number on a screen. It's ownership in a real business. If you buy one share of Apple, you own a tiny part of Apple. If you buy Coca-Cola, you own a small piece of Coca-Cola. That mindset completely changed Buffett's approach. Instead of predicting tomorrow's prices, he studied businesses, their profits, their management, their competitive advantage, and most importantly, whether people would still need their products decades later. Benjamin Graham introduced another famous idea. He called it Mr. Market. Imagine you own a business with a partner. Every morning, your partner knocks on your door, offering to either buy your share or sell you his. Some days, he's optimistic. He offers ridiculously high prices. Other days, he's terrified. He offers unbelievably low prices. That's exactly how the stock market behaves. Most investors panic. Buffett smiles. Because falling prices don't always mean bad businesses. Sometimes, they create incredible opportunities. While others were selling in fear, Buffett was quietly buying. For many years, Buffett searched for cheap companies. But another lesson changed everything. His business partner, Charlie Munger, convinced him that buying a wonderful company at a fair price is far better than buying a mediocre company at a bargain price. That's when Buffett began investing in companies with powerful brands, companies millions of people trusted, businesses with loyal customers, strong profits, and durable competitive advantages. This became known as the economic moat. Just like a castle protected by water, great businesses protect themselves from competitors. The wider the moat, the stronger the company. Then came one of the most famous investments in history. In 1988, after a market crash, Buffett began buying shares of Coca-Cola. Not because it was exciting, not because it was new, because almost everyone on Earth already knew the brand. People had been drinking Coca-Cola for generations, and Buffett believed they would continue drinking it for generations to come. That single investment grew into billions of dollars. Even today, it remains one of Berkshire Hathaway's most successful long-term holdings. Patience. Once again, 1. Warren Buffett didn't become a billionaire by predicting the future. He became one by buying extraordinary businesses, ignoring daily market noise, and allowing time to do the heavy lifting. His greatest advantage wasn't intelligence, it was patience. But Buffett's most unbelievable investment was still waiting. One decision would make Berkshire Hathaway worth hundreds of billions of dollars and cement his place as the greatest investor of all time.